So we're absolutely delighted to have Jason Crawshaw here with us today. Jason Crawshaw is a partner and portfolio manager at Polaris Capital Management. He joined Polaris as an analyst in January 2014. He was previously a portfolio manager with Liberty Square Asset Management, where he co-managed international long and long-short equity funds and helped to direct Liberty's research efforts. Prior to joining Liberty, he was a portfolio manager with Bright Specialized Funds, where he managed a U.S. long-short small-cap equity hedge fund. He served in a similar role at Equinox, a spin-off from Coronation Securities. Earlier in his career, Mr. Crawshaw was an equity analyst responsible for small and mid-cap research for a proprietary fund at First Rand and Coronation Securities of South Africa. Mr. Crawshaw obtained his MBA from the University of Notre Dame and his undergraduate degree from Middlebury College. Thank you for joining us today, Mr. Crawshaw.
Great. Well, thanks, Itai. Thanks so much for the opportunity this morning. It's certainly a pleasure to spend the next hour or so with you and your audience. I think what I'll do is let me just share my screen to get us kicked off here. Okay, everyone can see that okay?
Yeah, it looks good.
Perfect, great. All right, look, thanks so much. So I think what I'll do this morning is talk about clearly value investing and then really intertwine what I think is a current market dynamic, specifically around rising commodities and the impact of inflation. The way I'll do this is I'll talk a little bit about the background of Polaris. I'll spend some time talking about our style of value because I think it's a little bit different relative to some of our value peers. Clearly, I'm going to touch on this current theme in terms of this inflationary environment specific to commodities. And then what I'll do as well is I'll intertwine some stock examples that not only will illustrate sort of the theme that we're discussing, but hopefully will give the audience a sense of what kind of companies Polaris actually buys. So just a little bit of background here in terms of who Polaris is. We're a Boston-based firm. We were founded 1995, so we've got 25 years plus of investing history. We are pure global value managers, meaning we look for the best opportunities anywhere in the world. We're completely benchmark agnostic. I think that's the other thing. We don't manage to a benchmark. Quite frankly, we don't care about the benchmark. Everything that we do here is investment focused. We don't have a marketing arm. We really want to spend the entirety of our efforts trying to find the best investment opportunities anywhere in the world. In terms of the process, and I'll spend a little bit of time on this as we go forward, but really it's about cash flow. At the end of the day, that's the only metric that we focus on. And I'll talk about how our sort of style of cash flow is perhaps a little bit different than some other typical cash flow focused managers. And then lastly, I think we have the benefit of having a long track record. I think it's 35 years plus GIPS compliant track record, which is really helpful because it can certainly determine the efficacy of the strategy, but also can determine how we performed in all sorts of market environments. In terms of our objective and our philosophy, and then really how we go about it, what we're trying to do is we're trying to beat the benchmark, clearly, with lowering the benchmark risk. And the way we define this is we try to strive for 200 basis points of excess return on an annual basis. And lower the market risk for us is defined as having a cumulative rolling beta, which is a measure of volatility, of 1 or below, so less than the market. And just keep those two numbers in the back of your mind because we actually use those in our investment framework when we actually value a company. So 200 basis points of excess return with a cumulative rolling beta of 1 or below. In terms of what we look for, the only thing we focus on is cash flow and cash flow generation. We are looking for companies that generate cash flow consistently and then are good allocators of capital. I think one of the things that value investors often struggle with is they define value with so many different metrics. It might be price to tangible book, it might be EV to EBITDA, it might be cash flow, it might be a dividend yield strategy. Without sole focus and fixation on cash flow, it just means that we have a very consistent, repeatable, and sustainable investment process, which is really, really important. And at the end of the day, we think cash flow and cash flow generation is the best way to value companies. I think the other thing that's important here is that we're long-term investors. When we think about our investment horizon, it's really 5 to 10 years plus. We've owned things for the better part of a decade or longer. We don't focus on the short term. We don't care about this quarter. We don't care about next quarter. We really want to focus on a business that we think is well managed, generates a lot of cash flow, are good capital allocators, and manage well through the cycle. I'm just going to spend a couple of minutes here talking about how we define value and why perhaps it's a little bit different than a traditional DCF manager. So we use a discounted cash flow methodology, which is not unusual, but we have a little different spin on it. And what I mean by that is when we think about our cash flow, our numerator, this is the last step of our process in our DCF methodology, we don't use free cash flow. We use this concept of maintenance cash flow. And this is not a standard metric. This is a sort of proprietary Polaris sort of metric that we've developed over the years. And the way to just simply think about this is maintenance cash flow is cash flow from operations, which is for the purpose of this discussion, net income plus depreciation and amortization, assume working capital neutral for a second, minus maintenance capex. And this is really sort of the special sauce in that maintenance capex for us is the amount of capital that needs to be reinvested back into a business to keep cash flows constant in real terms. So we do everything on an inflation adjusted basis. And that's particularly important today because, perhaps over the past decade, there wasn't a huge amount of inflation. So the difference between nominal and real, was not significant. But clearly today, when we're seeing accelerated inflation, this idea of doing things in real terms is really, really important. And so what's different here is in a traditional DCF, your cash flow would be your cash flow from operations minus your total capex, and that would be your free cash flow. But we really are only thinking about what is required to be reinvested back into the business to keep these cash flows constant in real terms. And so what that means to us ultimately, at the end of the day, when we think about this numerator, we only want to assess the maintenance cash flow and ability of that business, but we only want to pay for that as well. We certainly like companies that can grow, and if you can grow a little bit, that's fantastic, but we don't want to pay for any of this growth. And so that is the fundamental framework and template that we have assessed every company in the world on. And it might be a bank, it might be a consumer discretionary company, it might be a mining company, it might be a software company. And so this is a singular template that we can apply across all industries, all sectors, and all geographies. Let me just jump now to the next slide. And this is the other part of the DCF, which is obviously our discount rate. And this comes back to the return objective that I had referenced at the outset. We're trying to beat the benchmark clearly. And in that case, we use a 7% real benchmark return in dollars. And that's what it's been over the past, call it 100 years, right? Again, we're not trying to forecast the future. We're making the determination that an equity investor can get this in an index strategy. So at a bare minimum, we have to beat that. So that's the first building block of our discount rate. The second is this active management premium. If I'm trying to beat the benchmark by 200 basis points on an annual basis, I have to embed this into our discount rate. So this 2% active management premium here you see on the screen, this is really a constant. This hasn't changed over the life of the firm. So 7 plus 2 gets you to 9%. And then the last component really is we have a country risk premium that we use because we're investing possibly anywhere and everywhere on a global basis. We don't hedge the currency in any market that we participate in, but we obviously have to embed some sort of country risk premium to factor in currency depreciation or sovereign risk and the like. And I won't get too detailed here because it can get a little bit academic, but we really use a country real yield, which is the 10-year bond rate minus the local CPI, to determine this country risk premium. Generally, we use a minimum of 1% or higher for a developed market, or 2% or higher for emerging market. We don't use negative country risk premiums, which was really an issue for the better part of the last 6 or 7 years when you saw negative rates on a global basis. The last thing, and I won't get into too much detail here, is the final step in this discount rate is we beta adjust the discount rate to reflect the beta of a specific company. So if a company has a 1 beta, that 7% equity return will be 7 times 1 is 7, plus 2 is 9, plus call it 1% for maybe a developed market is 10%. But if it's a higher beta stock, let's say it's a 1.5 beta stock, that 7 all of a sudden goes to 7 times 1.5, which is 10.5 plus 2, 12.5 plus 1, 13.5%. Meaning that we will invest in higher beta companies but they just have to be excessively cheap using this high discount rate for us to put them to the portfolio. That's really the last step in our process. We are bottoms-up fundamental investors. What that means to us is we have a front-end valuation screen where we can sort of screen 40,000 companies, really with the biggest criterion determinant being, does the company generate cash flow and cash flow consistently? And can we buy it cheap enough? And what cheap enough means to us is typically, if you're using a double-digit discount rate, you need a greater than 9% maintenance cash flow yield for the company to be kind of a net present value opportunity to, i.e., buy the stock. So that's the front-end screening process where we take 40,000 companies on a global basis, and this gets winnowed down to probably an opportunity set of, call it, 2,000 companies. The next step is, once we've identified a company that looks interesting, it's really investment 101, which is bottoms-up fundamental analysis, going out, seeing companies, meeting management teams, kicking the tires, really to determine two things. Does the company generate cash flow consistently? And then are they good allocators of excess cash flow? And the reason why I talk about capital allocation here is it doesn't help you to buy a company that generates a lot of cash flow and then takes your excess cash flow and does value destructive activities. And what we mean by value destructive activities is you could be investing in low return expansions. You could be buying companies at really high prices that you can never get a return on your capital back. You could be doing a number of things, but you really have to basically fulfill those two things. You have to generate cash flow, and you have to be a good capital allocator. And then the last thing is we try to create a portfolio of companies that have these characteristics. And typically, a global portfolio, we have anywhere between 75 to max 100 stocks at a given time. And again, because we're long-term investors, turnover tends to be fairly low. Typical turnover in our portfolio might be 15, 20% per year. Okay, so that's a little bit of the background on the firm. That's a little bit of sort of the academic framework, or the framework that we think about. But let's talk a little bit more about what's current in our minds, and certainly on investors' minds as well, and then how it's reflected in not only companies and possibly the portfolio. So, the big question on investors' minds is it finally value's time to shine? And as a value manager, we've seen certainly an environment for the better part of almost a decade where growth has meaningfully outperformed value. And why is this? Look, certainly the ultra low rate environment has favored growth stocks over value stocks, and part of that is just math. If you have low discount rates or low interest rates, obviously, cash flows in the future, people are willing to pay more for those. So if you are a growth company and promising cash flow further out, not cash flow today, investors will value that more highly. The other dynamic is obviously when you've got ultra low rates and you have access to capital cheaply and you've got excess liquidity, people's risk appetite generally is higher, right? So we had this combination of a low rate environment with some high risk taking, so certainly favored growth over value. What we have now is we see certainly a change at the margin, and this has really been probably for the better part of the last year or so, where we are seeing higher inflation, and we're going to talk about why, is driving higher interest rates, which is supportive for value stocks. And that's helpful, that's important, but that's not the whole story, because you can have this shift from growth to value, but at the end of the day, if you're a value manager, you still certainly have to outperform your value benchmark. And so the issue is, not only do you need to own value stocks, but you have to own the stocks, particularly in an inflationary environment, that not only can increase their prices, but increase their prices above the rate of inflation. Again, can you add value in real terms? And again, that's really, really critical. Okay, so let's move a little bit to what we're seeing more recently and times of the day. And so clearly this issue of transitory is important. And these are just a couple of headlines. And a lot of this information, it's timely because we have an annual client event that we just did this past January, so a couple of weeks ago. And unsurprising, the big kind of theme of the event was inflation. How does it impact our portfolio and various aspects relative to the economy and how things have changed. And so, a fair amount of this material is very fresh in our minds. And it's certainly critical because, for the better part, again, of a decade, we've been a really low inflation environment. In fact, in many aspects, deflationary. And you can see the headlines here that we've cribbed from a few newspapers. And in fact, if anything, it's probably accelerated over the last month or so. But this idea of transitory, I guess first and foremost, it all depends on what one's definition of transitory is, right? 6 months ago, I think when the Fed first came out and said, well, we see this as transitory, and I think in their minds this was maybe a couple of quarters or so, in discussions with the companies that we own, or we invest in, or we speak to, it was clear in our mind that this was not a 2-quarter event, meaning that, we were speaking to these companies that were only at the front end of seeing their costs rise. And they said, look, we're trying to raise prices now, but we've got 6 months to at least a year of catch up before we fully push these prices through to consumers. So at a bare minimum, we still see continued price pressures and inflation going forward. And ultimately, I guess in terms of how long transitory will be, history will be sort of the judge in hindsight. Let's talk a little bit about inflation currently and why it's important to aspects of the economy. And then specifically what I want to do is I want to focus on the right-hand side of this chart and focus on commodities. So we have inflation permeating through all parts of the economy, and I'll sort of just work my way counterclockwise here for the purpose of the presentation. So let's just start with logistics. Everyone's heard about kind of the shipping constraints. And, in some respects, we've seen this great globalization for the past 15, 20 years, which was fantastic when the global economy worked as a well-oiled machine. But because of COVID and all the kind of ancillary sort of derivative outcomes, we've seen some real changes. And one is obviously port congestion. And the fact that whether it's COVID related, whether it's sort of other factors, we've seen real challenges at the ports, clearly with moving product. That has been a huge issue in terms of not only getting product to the customer, but obviously getting product to the customer at a reasonable price. And so we've seen that in shipping. The same thing is with trucking. U.S. again, we've seen underinvestment in the trucking fleet. We've seen an aging sort of demographic in terms of who the truckers are. So that's been a huge issue in terms of inflationary pressures. The second is clearly labor. For the better part of 20 years, labor has really probably been at the short end of the stick for corporates, relative to corporates. And now, again, for various reasons, mostly COVID related and some demographic, we're seeing just a shortage of workers, which means that wages are rising. So that's another pressure to the system. Financials. And what we mean by this is we've seen many years of very high equity returns. Some might say asset inflation, some may say asset bubble. And certainly that has an inflationary effect as well. As people's balance sheets look very robust, they may spend more, they may decide to retire early. That feeds into the labor dynamic. But again, that's just another form of inflation. Housing, we all know what's going on in the housing market, whether you're a new home buyer, whether you're trying to rent, again, inflationary. Healthcare, and some of these issues I'm referencing here, we certainly have exposure to companies that benefit from this. In healthcare, for example, we've owned some of the lab companies. But again, I think anyone who's in the healthcare business or anyone who's paying a healthcare premium know not only has this been inflationary recently, but this has been sort of structural inflation. And then the last thing, consumer goods and probably autos is the most relevant issue here, given what we've seen in the semiconductor shortages, given what we've seen in terms of demand. We're seeing used car prices in some cases reaching new car prices. And so we really have this inflationary cycle that's driving all factors of the economy. And then lastly, just around commodities, we've seen inflation in power, electric prices, particularly in Europe. We've seen inflationary prices in raw materials. I'll talk a little bit about that. Clearly, industrial goods, components for semi chips and the like. Energy, we are now at north of $90 oil. We're at gas prices, both gasoline prices and natural gas prices, and even things like food. And we'll talk a little bit further on in the presentation how that impacts. But long story short, you've got all these different dynamics feeding into this inflationary narrative. I think if anyone's gone to the grocery store recently, if you fill at the pump, I think it's very easy to identify. Okay, well, let me talk a little bit more about sort of the subset of this inflationary dynamic, which is really on commodities. And we're going to talk a little bit more here about basic commodities. What we have here on the left-hand side of the chart, this is the CRB spot commodity index. It's really just a basket of basic raw materials that go into everyday end products. It's some metals, it's some grains, it's some energy and the like. And what you've seen over the past year, it's up more than 50%. Why is this? A couple of short-term dynamics, a couple of longer-term dynamics as well. The short-term dynamic is really, we've had this restart of the working capital cycle. When COVID hit, everything shut down. So factories shut down, factories curtailed production. Everyone basically worked off their inventory. And that was really a 2020 story. As you went through 2021, the economy rebounded. And as a result, you just had this rebuild of the working capital cycle, specifically for inventory, which consumed in a very short period of time a lot of all these inputs, raw materials to produce these products. So that's really a short-term dynamic. The longer-term dynamic is, for various reasons, there has been fairly significant underinvestment in new supply of commodities. And that may be because of economic considerations, maybe prices were too low, because of environmental considerations, in some case political or social considerations. You put these two dynamics together, you have a recipe for much higher prices. Let me just give you an example in terms of how high prices can actually go. And this is fairly extreme. What you have here is, on the left-hand side of the chart, you've got European natural gas prices, and you can see just a parabolic rise in prices over the past year. So I think this is a 5-year chart, but you can certainly see over the 2021 almost vertical. How did you get here? Again, a short-term and then a long-term dynamic. Short-term, 2020, as demand was weak in Europe, the Europeans chose to run down their stockpiles of natural gas. They said, look, we have no idea what the economy is going to look like. We don't want to buy new gas. We'll just run down inventory. So you had sort of this depletion of inventory. The long-term dynamic is Europe has a history of investing in renewable energy for obviously good reasons, things like solar and wind, but over the expense of natural gas. And so you've had this big build out in renewables in Europe over the past decade. But if you look at their ability to produce natural gas domestically, it's been in fairly persistent decline. So that's sort of a longer term dynamic. What happened in this past year, you had this sort of perfect storm of events. You had demand recovering as the European economy picked up. So all of a sudden there was demand for natural gas. You had this very strange environmental phenomenon where the wind power, the wind resource just didn't blow as anticipated this past year. And, I guess it sounds obvious in hindsight, but, wind power can be unpredictable given sort of the intermittent nature of it. And that was certainly seen in 2021. So all of a sudden you have kind of lower energy production out of this wind. And then you kind of throw in this added dynamic of geopolitics, meaning that Russia is this huge supplier of natural gas into Europe. And as a result, gas prices went up 10x, really an astronomical rise. What does this mean, and how does it kind of ripple through the supply chain? And then ultimately, how is it relevant to kind of companies that are impacted by this? Well, one of the biggest users for natural gas, particularly for a company that we own, Yara, which is a Norwegian fertilizer company, is that it's their biggest input cost to produce fertilizer. And as natural gas prices go higher, obviously it drives fertilizer prices higher. And then ultimately they have to pass on this increased cost to their farmers. And you can see natural gas prices were up 10x, fertilizer prices up 5 times this past year. So let me just take a quick detour for a second and talk about Yara here. And I think it'll give you a sense of the kind of companies that Polaris looks for as a value investor. So what does Yara do? They are probably the largest and best specialized fertilizer company in the world, meaning that what they provide fertilizer to farmers who obviously apply this to their crops to help generate the best available yields that they can serve the food industry. And what's a little bit more appealing to Yara for us relative to a sort of a specialty, rather commodity fertilizer company, is they focus on specialty fertilizers, which are admittedly at a higher price point, but this higher price point delivers better outcomes for the farmers, meaning that you get a better yield on your corn crop or your soy crop or whatever you're farming. And why that's important, particularly in the Yara model, is they're not just a producer, they also have distribution and sales and marketing downstream, where they're actually interfacing with the farmer. Because the reality is, if you're trying to educate, for example, an emerging market farmer why they should pay more for this specialty fertilizer, you have to sit down, discuss for the farmer, saying, look, you're going to pay 20 or 30% more for this ton of fertilizer, but guess what? You're going to get a 30 or 40% greater yield out of your crop. So economically, it sounds like you're paying more, but you're going to get a better economic outcome. And so that's really, really important to have this full scale integrated model. Clearly, right now, they're benefiting from a strong agricultural cycle, given that we're seeing grain prices up. But the other thing is that, again, they're looking for to build value over the long term. And that's really critical for any company that we look at, because they are very ESG focused, particularly given that they're an industry that is a carbon emitter. The fertilizer industry, the reality is you are emitting a fair amount of carbon. But the opportunity for them here is to leverage their top technology and move into things like green ammonia, which has a huge potential role in a carbon neutral economy. And so what we really like about this company is not only do they have a very good business for the here and now, but they are thinking about the next 10 or 20 years and how they can pivot and transition their business on a go-forward basis. And lastly, as I said at the outset, we really care about cash flow, and this company generates a tremendous amount of cash flow and they're returning it to shareholders. And in fact, right now, I think it's about 11% dividend yield, given that they're producing so much cash and giving it back to shareholders. In terms of how the stock's performed, look, we've owned this over the past 6 years. This is just a one-year chart. It's starting to perform nicely. It's been a pretty good performer, but in that period of time that we've owned it, the ag cycle was down, which was fine, because what they were doing is reinvesting in the appropriate parts of their business to position themselves for the upcycle. We think the stock is still incredibly attractive here. Why is the stock so cheap? I think the market doesn't really believe in the sustainability of this ag cycle, of these fertilizer prices. That's where we really think there's an opportunity. We think there's a lot of legs here. We still think the stock has a lot of value to still deliver to shareholders. So we're very enthusiastic about this name. So let's just jump back to the presentation and talk about how this commodity, in this case specifically around fertilizer, continues to ripple through the supply chain. So I talked about fertilizer prices being higher. Obviously, farmers have to take this fertilizer, put it on their crops, but their costs are now higher. So what do? They try to pass it on to the customer. And in this case, grains, soybean, corn, etc., are used to feed animals as one of the kind of the end markets, right? And so what they may do is they'll pass it on to a protein producer like Tyson. I think your audience has probably heard of Tyson. They're one of the biggest sort of chicken and protein producers in the US, if not the world. And so in the case of Tyson, when they see higher grain prices, what do? They have to pass the cost on to the consumer. And so in this case, what you'll see is, again, on the left-hand side of the chart, you'll see ground beef prices, which is effectively hamburger, up 20% this past year. So again, what starts as sort of a shortage of natural gas ripples into a fertilizer issue, ripples into a grain issue, ripples ultimately into a food issue. And so you can see just the interconnection of these commodities in the value chain. Is this cyclical or structural? I think I would probably argue that energy prices and grain prices, it's probably more of a cyclical dynamic as opposed to a longer term structural dynamic. But this is going to take time to resolve. This is not going to be resolved in a quarter or two. You could be in a multi-year cycle here. So let's just jump over to another stock that we own in the portfolio. Again, Tyson. I think the idea here is a chicken in every pot, to steal a phrase. What's important here? From a longer term perspective, we're seeing increasing global demand for protein, given that, as emerging markets grow and as disposable income increases, you move up the value chain, you want to eat more proteins. What we like here is they've got a diversified portfolio of leading brands, and I think this idea of diversification is really, really important. It's important in our entire portfolio. We also like it when we can see diversification in a company for various reasons, and I'll talk about why. Clearly, we're seeing higher input costs, but they're being able to pass this on in prices. In terms of diversification, I referenced, you can see it's a chicken producer, but it's also a beef producer. They've got pork, they've got prepared foods, they've got branded products. And again, this ability to pass on price is important. And the reason they can do this is they have dominant market positions. What you've seen in the processing industry and the food industry over a number of years is you've seen a lot of consolidation. And as a result, this consolidated market lends itself to this ability to push through these prices. And I think lastly here, we think the quality of the business is underappreciated by the market. What I would also say here is that it's a cheap stock, but we think there's real quality to this business. And what I mean by quality is not only this ability to push through prices, but this portfolio effect is really important, right? Because if you're a pure chicken producer, like a Sanderson Farms, which is, by the way, a very good company, that's great, but that has a really volatile cycle. The fact that they've got all these different proteins, whether it be beef, chicken, or pork, is really important, because what you've seen over the past year or two, particularly for Tyson, is their chicken business has been really down, but the beef business has been really strong. And so I think what we see in the opportunity is people view this as just a commodity protein producer, but we just see it as a very good portfolio that has sort of ebbs and flows and a very nice diversification effect that can really smooth those cash flows out through the cycle, which we think is really, really important. In terms of performance of the stock, as you can see, it's been a very good performer over the past year. But again, I think we would argue that this business is still underappreciated by the market. It's probably 10 times earnings, 8 or 9% cash flow yield. And, I think the skepticism that this continued ability to pass through price or manage price is one thing that I think leads to kind of the cheap valuation of the stock. I think the other dynamic, and you're seeing this more in the headlines, is clearly there seems to be some political risk, regulatory risk around the protein producers. Not to be political, but obviously when you're seeing inflation at high and you have consumers going to the food market and it's impacting their wallet, clearly from a political perspective, the industry has been singled out as saying, well, I think I've seen the term, big meat being passed around, sort of like big oil. And so I think one of the issues around the industry a little bit is this idea that there could be some sort of, regulatory action specific to the protein producers. And look, we'll watch that and monitor that really carefully. But, I think we think that's a little bit more political rhetoric in terms of actual enforceable activity. And so, again, we think the market's probably been a little bit too punitive in terms of the valuation there. Let's just jump to one of perhaps the last commodity I want to talk about. And this is really something that we think is a little bit more structural, and that's the copper market, right? So we've talked about natural gas, we've talked about some of the grains, some of the meats, the proteins rather, as perhaps being kind of cyclical, but extended cyclical, to something that we think is a little bit more structural. And this is the copper market. And why are we so optimistic on this specific commodity? Two reasons. First of all, demand. Let's just talk about demand for a second. Copper demand historically has been very good, sort of been GDP growth plus, because you've got good industrial applications, you've got electrification, you've got all sorts of ongoing benefits and sources of demand for copper. The new dynamic, though, obviously, is the advent of the electric vehicle, right? And that's been a huge new source of demand in a very short period of time. So, and if you look at the chart on the left, really from de minimis demand, 3-4 years ago, you've got EV consuming close to 10% of copper demand in the market in 2022. And in fact, that's the forecast. And the demand stems from two areas. Clearly, you need all the infrastructure, right? So all obviously the charging stations, even the continued build out of the electric grid to kind of support all the kind of increased electricity demand is one source of demand. And then obviously electric vehicles themselves consume a fair amount of copper. So you've got this really new source of demand, which is very advantageous for producers of copper. So demand looks incredibly good, very robust. The supply side, not so good, extremely challenged. And there's a number of reasons why. The first is political instability. The reality is most of the copper in the world is mined in places that for one reason or another have less stable governmental situations. In South America, Chile and Peru rather are big copper producers, and historically fairly stable governments and a good place to mine. But we've had recent elections there. There's some rethink in terms of basically, particularly around sort of taxes and what role the mining industry and what sort of the more equitable economics around mining that are coming to in question there. Places like Indonesia is a big copper producer, the Democratic Republic of Congo, Zambia. So you've just got political instability, which is an issue in terms of just current potential production, but also more importantly, future investment. Because if the economic terms are going to change, if there's less stability around the political aspect, new investment in those markets are going to be at least require a higher rate of return at a bare minimum. So that's one aspect. The second is really around environmental, and not only environmental in the sense of having to have more stringent environmental regulations to get permitted on a new copper mine, but even just environmental factors to operate existing mines. As an example, shortage of water. Chile has been in a fairly meaningful drought for a number of years, which means that a lot of these copper producers, these copper mines, they use water to help process the copper and help mine the copper. And in Chile, for example, the water shortage has become so acute that a lot of the copper producers have had to curtail some of their existing production in the short term. And what it's actually meant is what they've done is they've actually invested a lot of capital to bring water from the ocean through this desalinization plants, et cetera, to service the mines in the future. So the water issue will be solved there, but it's going to take some time, and there is a longer term plan. But in the short term, that's been a real impediment until we see more normalized rain in Chile. So that's one example as an environmental sort of consideration. The second would be just reliable electricity. Specifically in places like Africa, again, the DRC and Zambia, you've seen some challenges with having uptime with electric power. So again, that can be another challenge. The last dynamic is really just geologic, function of nature. And what I mean by that is that if you look at many of the best and biggest copper mines in the world, they were found decades ago. And now they've been operating for 10, 20, 30, even 40 years. And as a mine gets mined out, the grades decline, which means a mine becomes less productive and more costly to operate. So the reality is you've just got the structural declining grade decline in the copper industry. So again, why are we so optimistic? You've got this great demand profile. You've got this very constrained supply profile, which means, unsurprisingly, the copper prices are up more than 50% over the past year. And so how does this come back to kind of value investing, or how we think about things at Polaris? We had sort of identified this as something that we wanted to get more exposure to in 2020 during kind of the big meltdown in, I think it was March or early April of 2020. We bought what we think is one of the best mining companies in the world, Antofagasta. It's a Chilean miner. And then as we kind of worked through the pandemic and we became more convinced of this structural dynamic, we bought another company this past year, a Canadian mining company called Lundin Mining. So let me take the last departure here in terms of a company in the portfolio. And again, I think this will give you a little bit of a flavor. And as discussed, Lundin Mining, Canadian mining company. What do we like? A little bit of diversification again. And if you can see the left-hand side of the slide, not just Chile, right? You've got Brazil, you've got Portugal, you have the US, you've got Sweden. So from a political perspective, clearly still, Chile is the biggest single jurisdiction, but they've got a portfolio of assets in different places, which is really, really important from a political diversification perspective. The other reality is they've got big exposure to copper, which we like, but they have also got exposure to some other materials, what we think is important. So again, this diversified portfolio of mines and metals is particularly important. The second, really good management and a history of value creation. And this is critical in the mining space, because probably one of the big objections for all investors, particularly in the mining space over the years, is that there's sort of been this boom bust mentality of mining companies to basically make a lot of money and then go allocate capital badly, okay? They take all your excess cash flow and they go buy assets at the peak of the cycle. They go invest in these really low return projects. And so we really want to only invest in mining companies that have very good history of value creation, meaning by and large that they're almost counter-cyclical, meaning they want to invest when things are miserable and they want to return capital to investors when things are really good, not the other way around. And what that means for us, again, is that they've got this great balance sheet, and because things are so good right now, they're returning capital to shareholders, not only in the form of a regular dividend, but a special dividend and a share buyback as well. So that's really the thesis and the story around Lundin. Where did we get involved, and what was the opportunity here? It goes back to my opening comment, is we look for long-term investment. So we're thinking about 5 to 10 year investment horizons. In the case of Lundin, we had identified the fact that we wanted to be involved, more in the copper industry, but we wanted to be really selective in terms of what companies we owned. And we had our eye on this business. But what happened is in early 2021, we had a little bit of kind of a pullback in the copper price that brought some of these copper stocks down. But more importantly, Lundin had some short-term operational issues at one of their new mines that they're expanding. And the market, again, focusing on the short term, really sold the stock off. And so we started, the stock went from, I think, about 13, about 8. So that's a 30, 35% correction around mostly these short-term operational issues, right? And for us, again, being able to take this long-term view of 5 to 10 years, these short-term dislocations by investors who are focusing on the short term ultimately presents the opportunities for an investor like us who says, well, we don't care about these short-term operational issues because we have a high degree of conviction that they can be resolved. And this ultimately provides us with a really good, compelling investment time to step up and buy. And so in this case, it was critical for us to stay disciplined, wait for our price, the right time to buy the stock, and we've are happily here to say that we've been able to kind of build a full position during this downturn. All right, so maybe just to kind of summarize what we've discussed here today. Clearly, I think we've talked about how our style of value is a little bit different than other value investors. Really, this idea of focusing on maintenance cash flow, having a high discount rate, typically double digit. And then more specifically in terms of what we're seeing in a certain subset of the market where we do have some investments, which means in the commodity space, we do believe that in the supply-demand dynamics are certainly the benefit of suppliers. So if you're either raw material, industrial, chemical, oil, or other aspects of the industry, we're seeing a really strong cycle in that area of the market. There is a saying in the commodity space, though, the cure for higher prices is higher prices, right? Because at the end of the day, higher prices will lead ultimately to two things. A little bit of demand destruction, meaning that people will, eat less steak. In one example, they'll curtail their driving habits if gas prices are too high. And ultimately, if these prices are high, there will be new sources of supply. People will expand mining capacity. People might expand, chicken capacity. But I think the message is that we don't think this is a 1 or 2 quarter event. We've been in this period of depressed commodity prices for a number of years. It's going to take time, and it goes back to this issue of a number of factors leading to longer term periods of prior underinvestment that are going to take some time to resolve themselves. How is it impact on our portfolio? We think it's helpful because this inflation, particularly for the companies that can raise prices in real terms, are going to grow their cash flow. As we've discussed, we've seen this ripple down through the supply chain, ultimately at the expense of the consumer, which we're hearing a lot about now. And then lastly, I think, hopefully with a couple of examples that I've shared, you can see that, we only want to be invested, particularly in the commodity space, only in the best commodity companies. You have to be a low-cost producer. You have to have a differentiated offering. You have to basically have a plan for the future going forward. And again, that's really a hallmark of the kind of companies that we look for. So maybe I'll stop there and just see if there's some questions that have come out of this presentation. I'm happy to field those now.
Yeah, thank you for that presentation. It was really great, very informative, and very helpful. Are there any structural metals other than the copper that you think in the long term also would be in a very large supply deficit?
Yeah, that's a great question. There are a couple. So probably the first that comes to mind is cobalt. So cobalt is critical for batteries for EVs. In fact, I was on a call yesterday. There's one of the large global mining companies, Glencore, which is probably the biggest cobalt miner in the world, was actually sort of asked a specific question. So I'm sort of stealing a little bit of their notes here, but cobalt is certainly the preferred commodity. I think for investors, that's a little bit of a challenge because it's actually such a niche commodity, because it's in scarcity supply, and there are very few pure cobalt producers. So I think that's one. I think the other commodity, again, nickel, in some respect, again, because it's important for battery technology. The only dynamic a little bit with nickel is there are other kinds of nickel at higher prices that can be substituted in for some of this better grade nickel. So in some respects, there's a little bit of a cap on the nickel price. Maybe the other comment I would also make, and this was an interesting sort of discussion in this Glencore call yesterday, was another way potentially to kind of play this theme is some of the companies that recycle, right? Because, particularly cobalt or some of these other commodities, given the scarcity value, there's just going to have to be a lot of recycling capacity put in and utilized, because you can only pull so much out of the ground on an economic basis. And so companies that have exposure to kind of recycling capabilities, and even sort of, this is a little bit of a stretch, but you might get there eventually. Historically, mining companies have big smelting operations, which for years were viewed as liabilities, right? Because, they were environmentally unfriendly, but B, they were sort of only purposed for one aspect. Some of those those smelting assets are being repurposed to be recycling assets. And so that could be a very interesting sort of derivative way to think about getting exposure to some of these commodities, but in a non-conventional way.
Yeah, absolutely. And can you talk a little bit about how you analyze pharmaceutical companies like Jazz Pharmaceuticals, please?
Yeah, no, that's a really good question. So the way, and specifically for Jazz, so we would analyze a pharmaceutical company no differently than any other business, right? Meaning that, there has to be a product or a service that produces cash, right? And then the issue is, okay, you've produced this cash, what have you done with the excess cash? So in the case of Jazz specifically, and my colleague Jamie White did a lot of really good research on this one. The idea here is they've got an existing product set specifically for narcolepsy. I mean, it's a very sort of, in some cases, sort of niche indication, but it has, very meaningful sort of health ramifications. So that they've got a very good product patented that's specifically focuses for the treatment of narcolepsy, which is a high cash flow generative product for them. So they make a lot of money out of this narcolepsy drug. And admittedly, there's a generic coming in, I think at the end of this year, but they've already got the next formulation that is a better product that they think will sort of drive kind of the cash flow going forward. So that's sort of the base cash flow. Kind of the growth cash flow, which we're not paying for, is they made an acquisition about a year and a half ago, a company called GW Pharmaceuticals, which has some very interesting drugs really around epilepsy and epilepsy-related indications. And so, again, when we look at Jazz, we think we're only paying for the narcolepsy franchise. We get the epilepsy franchise for free. So again, that's how we think about a company like Jazz.
Yeah, that makes a lot of sense. And then switching to discussing banks a little bit,
Yep.
Banks tend to have, the balance sheets are very complex. They tend to have somewhat of a black box element. How do you get comfortable with that? Because you have significant investments in banks.
Yeah, and that's a great question. I'm glad you asked it. And if you look at our portfolio, we generally steer clear of those black box banks, right? We like, so yes, we own JP Morgan. Do I know entirely what's in JP Morgan? Not entirely, but I think we've got a high degree of confidence given kind of the way that business is managed, that they've got a fairly good handle on their risk management. But that's sort of the outlier. If you look at most of our banks, they're very simple, plain vanilla. They take deposits, they make loans, right? It's really a spread business. And so our bank exposure specifically is a lot of the smaller regional sized banks, whether they be US banks, whether they be European banks. And maybe just to kind of hammer this point home, if you look at European banking exposure, for years, a lot of the continental European banks, the German banks or the French banks have been on our screens as being cheap, but precisely because of this issue of they do everything. They're sort of this universal bank with an investment bank, derivative book, proprietary products. We just haven't had comfortable investing in those banks. So we like very plain vanilla. You take a deposit, you make a loan, you know the customer, banking 101.
Yeah, that makes a lot of sense, and thank you for that commentary. You estimate maintenance capex when it's not reported. Many companies won't discuss their capex too much; they'll just give a total capex.
Yeah, no, and that's a great question, and it's critical to what we do. The way twofold. We have a lot of discussions with the management team, just thinking about their thoughts. First and foremost, of how would they define it given our definition, and they'll think about it, and they'll either kind of understand the way we define it, or ask for more clarity. And so we can get some help, but that's just one part of the equation, because you don't want to take management's word. What we often do is just back test, right? We look at a company and we just say, look, if cash flow from operations was 100 million 10 years ago, right? And it's 100 million today in real terms, meaning it hasn't grown in real terms. That's fine. But in that case, the entire CapEx, right, is actually maintenance CapEx. So you can tell us what percentage is maintenance. You can tell us what percentage is growth. The fact that you haven't grown cash flows in real terms by default, and if you've done acquisitions, would include that in your maintenance CapEx. So there's a really kind of efficient way you can kind of tease it out by looking backwards and trying to understand how much is the cash flows growth, how much cash flow has grown, and then try to figure out how much of that was required to kind of support the business and then grow the business. So that's generally how we do it, but it's a great question.
Yeah, absolutely. Thank you for that. And also, it's interesting to me you're focused on beta. I mean, you have a lot of value investors that just sort of disregard beta, don't focus on that. So can you discuss why you've chosen to focus on beta?
Yeah, I mean, at the end of the day, we want to generate alpha, right? And so, if we only focus on that 2% excess return, right, over the benchmark, but we take abnormal risk to get there, right? Then at the end of the day, we might be producing excess return, but when we beta adjust it, right, maybe we're actually just taking more risk than the benchmark, right? And so for us, the most critical aspect is actually generate alpha, because that's really what, the value we bring to the clients, and that's what we get paid for. And so, you can't have one without the other. So that's why we beta adjust and we apply beta to the portfolio, because we want to deliver true value to the customer, not just take excess risk.
Yeah, absolutely. That makes a lot of sense. And we've spoken about some of your past successful investments today. Can you speak about a past investment where you had a thesis and it didn't quite go according to plan and it didn't end up working out?
Yeah. Look, generally, if we go back to things that, here's a good example. So we owned Teva Pharmaceuticals, right? And almost you can relate this to your previous question of Jazz, right? So Teva, great long-term track record, great value creator. In their case, they had a drug specific to MS that was coming off patent. Good franchise, but was going to get generic competition, right? were well prepared for that. They had some other products, right? So the underlying business itself, the cash flow generation was fine. The big issue was the capital allocation, right? And one could argue maybe they did this because perhaps they felt the underlying franchise wasn't as stable as perhaps investors thought, or perhaps they kind of had a different view of the future. But they went out and they did a really large acquisition. I think it was 2015, 2016, where they bought a very big generics business. They funded almost entirely with debt capital. And specifically, what it meant was doing a very expensive acquisition at precisely the top of the market, specifically for the generic industry, because you had some things that happened after, you had some acceleration of generic deflation. And so long story short, the mistake that Teva made, and ultimately the mistake that we made, because we have to own these mistakes, is not the base business, not that they were bad allocators of capital in the past, is they made a departure in terms of capital allocation on a go-forward basis. They basically made a very large deal that was value destructive and levering the balance sheet at precisely the wrong time. And so then what happened is subsequently is you had some things going on in the generic industry, you had more competition for their MS drug, and you overlay a leveraged balance sheet on top of this, which led to basically the perfect storm. And that was a very bad outcome, not only for the company and for us, quite frankly.
Yeah, absolutely. That makes a lot of sense. And can you talk about your thesis on Infosys, please?
Yeah, Infosys has been a really good long-term investment for us. We've owned this company for probably more than a decade. And I think the thesis for Infosys for us when we bought it is, you had obviously some very good secular tailwinds. We thought they had a very good kind of value proposition to the end customer. Admittedly, there has been some management turnover in prior years, which was a little bit disconcerting, but they resolved that. And when we bought the stock, all those things weren't recognized by the market, and it was cheap. Today, it is not a cheap stock. And so if you look at our portfolio, there will be a handful of companies that we've owned for years and years and years, right, that have just always exceeded our cash flow expectations. And then the market has rewarded them for that and has become more expensive. And so, Infosys for us is a stock that ultimately, would probably be a source of cash. And what I mean by that is when we have a new idea coming into the portfolio, Infosys could be in one of the handful of stocks that ultimately will leave the portfolio, because although we think it's a fantastic company, although they're generating a lot of growth, it's just getting too expensive for us to own.
Yeah, absolutely. That makes a lot of sense. And your thesis on SK Hynix?
Yeah, here, they're one of the largest DRAM manufacturers in the world. Historically, an industry that is very volatile. But what we've seen over the past 5 to 10 years, you've seen consolidation of that industry, right? So you've got just a handful of players now, whether it be SK Hynix, whether you got Samsung, you've got a couple others. And that doesn't mean that DRAM pricing isn't going to be volatile. It always is, and it always will be. And it's generally going to be deflationary. But you've just got better discipline around capacity expansion because of the consolidated nature of the industry. And so, obviously there's a good long-term structural dynamic in terms of the demand side. I think people always have understood that and recognized that. I think what we think is more important is there's just more discipline on the supply side that we think investors probably underappreciate.
Yeah, absolutely. And your thesis for Linde as well, please?
Yeah, Linde, this is the industrial gas business. Again, this speaks to a consolidated industry. It is a great, one would almost argue, oligopoly between Linde and Air Liquide's. And in fact, Linde was a merger of Linde, the German company, and Praxair, the US company. So the industry became more consolidated. These are long-term plans, long-term customers, long-term contracts. Prices go up 2, 3, 4% every year. And it's just a very high quality, very good business. Admittedly getting more expensive because the market is recognizing, again, kind of the quality of kind of the franchise and kind of the kind of almost the impervious nature of the industry to kind of, new competition. Again, really good company, a little bit expensive.
Yes. And what qualities, backgrounds, and experiences are you looking for in college students who dream of one day interning at Polaris?
That's a really great question. And I think the way we've built our team, first and foremost, is a very diverse group of people, right? As global investors, you want people from different backgrounds, different geographies, different sort of cultural dynamics. And so we've got, the way I would describe it is we've got the United Nations of an investment team at Polaris, whether it be, I'm from South Africa originally, believe it or not. We've got people from Asia. We've got obviously Americans. And so I think having kind of diverse backgrounds is really helpful. And then also diverse sort of academic backgrounds. Again, we've got people who have engineering backgrounds. We've got people who've got business backgrounds. Believe it or not, I was a history major in college, so I have a liberal arts background. But you really want people with a diverse set of skill sets, because that really ultimately, when you blend it all together, and particularly in a kind of the way the team works, leads to a great outcome. So I think that's important. I think the other thing is just people who are passionate about what they do and are just intellectually curious. I mean, that's the greatest thing about my job is every day I can wake up and look at a new company, a new industry, and we run a generalist model, right? I think that's really advantageous, right? So, there are 42,000 companies in the world. I can go out on a daily basis and look at, this company that might be an internet company in Kazakhstan, okay, or a Brazilian bank, or a company that drills for oil in West Texas. And so, just if you're a really curious, intellectually curious person, and likes learning about different businesses, sort of the generalist global investor model is fantastic.
That sounds excellent. And for a concluding question, which events have been the most influential in your investing career?
Wow. Yeah, no, that's a really good question. So I've been in the markets now 28 years. And I think the events that are the most influential are the crises that you go through, right? So I started in 94. So you had the emerging market Asian crisis in 97, okay? So you learn a little bit about that. Then you had the dot-com bubble, the dot-com bust in 2000, 2001. You learn a little bit about that. Then you had the global financial crisis in 2008, 9. You learn something from that. And then obviously you had the COVID pandemic. And so I think the things that I've learned, in these periods of dislocation, of stress, of volatility, if you can find companies that produce cash flow consistently, when everyone else is panicking, right, and just saying, get me out at any price, I just need liquidity. If you have a list of companies that are just really good businesses that you understand well and produce a lot of cash, you'll have the conviction to step up in those darkest times and say, look, this company's, at a bargain price. This is the time I want to buy it, right? And, I think, Buffett has the old saying, be fearful when people are greedy and be greedy when people are fearful. I think, given the experiences that I've gone through in the market, and given the fact that we can take a long-term perspective, these dislocations at the time, they feel painful, but these are the things that actually allow you to kind of plant the seeds for future returns. And so those are the things that we actually get probably the most excited about, but again, have been probably the most influential in my investment career.
This has been a really phenomenal session, and really appreciate you taking the time out of your busy schedule to speak with us today.
Great. Well, thanks for the opportunity. I appreciate it. And again, this has been a great Q&A that we've had. And if there's any follow-up, certainly happy to answer any questions in the future. But again, thanks for the opportunity.
Excellent. Will do. Thanks. Have a good day.
Bye-bye.
So Jason had to catch a plane after our initial interview, but he was very kind to take the time to return and answer all of your remaining questions. So thank you, Jason. We greatly appreciate it. Do you use quantitative or keyword screeners? And if yes, how so?
So a great question. What we actually use is we have a quantitative screening methodology at the front end of our process where we take 44,000 companies on a global basis, put them through various filters, the most important of which would be clearly cash flow generation, We filter out some further criteria specifically designed around eliminating value traps, and ultimately gives us a pool of 1,500 to 2,000, 2,500 companies that is the ultimate pool for us to fish.
And what are your thoughts on investing in China?
Look, China is very well represented in our opportunity set, specifically those screens that I just mentioned. It's probably in the top 3 consistently. As a result, we spend a lot of time looking at the Chinese market, traveling there, spending time to really identify investment opportunities in the region. I think one of the challenges we've had historically is that many of the companies that come up on our screens in China would be either the big Chinese banks or some of the state-owned enterprises. And we've had limited appetite for various reasons, including transparency or the quality of the business. As a result, we really haven't had a lot of Chinese exposure historically, maybe a handful of 1 or 2 stocks here or there. However, I will add that we've seen material underperformance in the Chinese market over the past 12 to 18 months. And as a result, some more interesting companies are starting to come on our screens. Probably not cheap enough for us to buy currently, but certainly worthy of warranting more attention from a research perspective.
And what are your thoughts on investing in Japan?
Similar to China, Japan is, again, well represented on our screens as an area of substantial value. We have decades of experience there specifically, and do spend a fair amount of time traveling and meeting with Japanese companies. I think the issue in Japan is we do find many businesses that are good companies and are cheap. They generate a lot of cash flow. I think the broader issue is really around the capital allocation of the excess cash flow. What are they doing with the excess cash flow? Are they investing it wisely? Are they returning it to shareholders? And so in the case of Japan, like all markets, it's really important that you check both boxes. Are you cheap, and are you a good capital allocator? And, we have found companies, whether it be a Marubeni Corp or a Sony, for example, that has checked both boxes. So it is an interesting area of the world for us.
And what are your thoughts on the automotive industry today?
In terms of the automotive manufacturers, the OEMs, we do have some exposure there. We own Kia, which is obviously the Korean manufacturer. We own Honda as well. We think these are well-managed companies, have good balance sheets, good operators, and obviously very attractively priced. In terms of the dealers, we actually do not have any exposure to the dealers. And the reason is we just think that the margins and the profitabilities at the dealership groups right now is excessive. Clearly, the shortage of automobiles has hurt them in terms of volume, but they've more than made it up for it in price and margin. And so we just don't believe that the sustainability of the margins and the cash flows for the dealers make sense at these levels. And so we do not own any of those companies.
Thank you, Jason. It's been a pleasure. And we greatly thank you for taking the time out of your busy schedule to answer these additional questions today.